tariffs hurt the existing sort of stock of assets, and that's what the stock market reflects. And so, I think it's much more of an impact on corporate earnings than it will be on the economy. I think the benefits of trade to the U.S. economy, frankly, have been dramatically oversold by a lot of people over the last, 2 to 3 decades. And if you just sort of run the numbers, I mean, if we're talking about the tariffs that are being threatened by the end of the year, you're basically neutralizing most of the tax fiscal stimulus that's been put in train. But it's important for investors to remember that the momentum in the U.S. economy is still pretty healthy. I mean, consumer confidence is strong.
But the market's saying, Neil, that it may not be.
Yeah, I mean, the markets can say a lot of things at any given time. I mean, the yield curve is still positively sloped. Corporate credit conditions still look reasonably healthy. So, this has been a bad time for the equity markets. But I think ultimately decent economic news can help turn the markets. The question you have to ask yourself is, the speed of this decline is frankly consistent with recessionary-like outcomes for equities historically. I don't think we're going into a recession. And I think over time, the equity market should come around to that view.
Matt, what is the chatter today? What caused that big reversal, now down 206 on the Dow?
I just think it's investor psychology right now, or for trader psychology. It's not so much the investor anymore. We're starting to see the sell the rip, don't buy the dip mentality. So these markets get extended, trend lines get broken, and when they do, it's an exaggerated move to the downside. And that's certainly what we're seeing. You look in the S&P minis today, they're far performing on the downside to the S&P. That just shows how nimble traders want to be, and they're not prepared to take a real position at this time. You don't hear anyone dollar cost averaging into an Amazon right now. You only hear about on the upside.
Yeah, Kate, listen, there's 2 ways this could go, because you've got we're in this weird period where there are almost no corporate buybacks because we're around the earnings period. And you've also got the end of the year for many, but not all, but many mutual funds. So you may have some tax loss selling as well. Do you think this last 2 weeks is going to be representative of the next 2 months? Or is this just kind of that odd period of time in what is still going to be a strong equity market?
I think it's an odd period of time in what's likely to be a strong equity market, but between now and the end of the year is awfully short term. So I think more importantly for most investors, you need to look a little further out. Keep in mind that, yes, there are a lot of strange things happening, and I think investors really are reacting very much. They're sitting on the edge of their seats. They're reacting to every piece of data as though that gives you direction over the next year, and it probably doesn't. And that's really why we're seeing a lot of the ups and downs in the markets and such sharp moves.
What's the bond market telling you, Rick, on that front? I mean, Neil mentioned that we've still got a positive yield curve. Yields are higher. You're not seeing any dramatic concern about a recession in the bond market, are you?
No, as a matter of fact, the more closely you pay attention to the fixed income market, especially the long end of the fixed income market, the more one would think that what's going on in equities is definitely an event to pay attention to, but an event that should have an outcome over time that doesn't ding investors in a huge way. Otherwise, I would think that the Treasury complex would be much less buoyant with regard to interest rates. Even as we sit now virtually on the low yields of the day, we're still higher only by a basis point or two on most maturities. And as we sit at 308, we are 14 basis points away from the high yield close of 7 years. Now, I'm not saying that things can't deteriorate further, but just by looking at the interest rate complex, one would think that the economy may be idling a little less quickly than it was in many investors' minds, but ultimately the volatility in equities isn't a binary event. And the Treasury market seems to be getting it enough time to come up with a bottom that we can all live with. The notion of losing strength at the end of the session in equities, the way we have several sessions, is not a good sign that we're going to come in tomorrow and everything's going to be all clear.
Yeah, you ever see, Neil, the movie Usual Suspects? No. Kaiser Soze? Yeah. Anyway, how about this? 325 on the 10-year was kind of the boogeyman then, the Kaiser Soze of the market.
Right.
Something you talk about, but you never saw it and it was coming. And people said that's the reason, in one way, that stocks were selling. We're back at 308. And what if we get some dovish statements from the Fed? Suddenly that interest rate as the market boogeyman story goes away.
Well, I think so. I mean, I think for the Fed, there's probably a big difference between an equity sell-off driven by higher rates versus one that's being confirmed by lower rates. And this one looks like.
Okay, how does the Fed interpret this sell-off then?
They're probably paying attention to it, but they're not willing to adjust their rate hiking plans yet. Now, that being said, the president recently made news about calling the Fed loco, and I think that's something we have to keep an eye on as investors because, the dollar, in my view, is really the escape valve for all of this, and the dollar's moving up, and that almost has a mechanical impact on the Fed's forecast for inflation. So if the dollar's strengthening, that's going to sort of not only neutralize the impact of tariffs, but it's going to introduce downside risk, in my view, to core goods consumer prices. We know that household inflation expectations are stable. If you look at break-evens in the market, they've actually been coming in as the dollar's been strengthening. So this is something that should get the Fed's attention, and I think over time actually get them to skip a meeting or two next year.
So PCE, Fed's preferred inflation gauge, came out today, 2% year over year. That's on target, and I think it vindicates what they've been doing. The question is, does that move
The momentum
lower?
has been terrible, Sarah.
Right, it's gone down.
Look at it over the last 3 months. Look at it over the last 6 months. It's not consistent with 2%. We have news reports every day talking about how rents are slowing in many markets across the country. So I just think that there's this sort of view that inflation's going to take off, that the Phillips curve is sort of kinked at these low rates of unemployment. I'm not so sure that's the case, and so I think that provides the Fed some room. I'm not saying don't raise interest rates, but they don't need to be reiterating that we're going to go 3 times, we're going to go 4 times next year. They should be data dependent, and right now the data don't justify the current pace that they're telling us they're going.